you here and really appreciate your engagement at this session in partnership between Rio and Coller Capital. I am joined here by Matthew Alcock, which I'll let himself present later. And wanted to thank you for your engagements and joining the session. It is highly appreciated. My name is Thomas Bruden. I'm an associate director at Rio AI, supporting a range of clients on the ESG data collection, software, consulting, strategy, and general engagement for net zero and operational efficiencies. My background before joining Rio is I worked at Deloitte in the sustainable finance team in risk advisory, and I have supported FTSE-listed companies, a range of different players on ESG regulation and compliance and data gathering and strategy more generally. So again, just to reiterate, thank you so much for your engagement and your participation. We're really looking forward to this discussion. And having done my introduction, I'll hand over to Matt to present himself at Coller Capital.
Thank you, Thomas. So hi all, my name is Matthew Alcock. I am a sustainability associate within the investment team at Coller Capital and have been here for close to 2 years. I am a qualified accountant by background, so also from Deloitte, so some similarities there. Although I started my sustainability journey a couple of years ago. Coller Capital is a secondary specific private equity firm who has close to 40 billion in AUM. And for those who don't know, secondaries refers to the buying and selling of pre-existing investments in the private equity market. This often comes with complexity given we are further removed from our underlying investments and often have over 1,000 underlying companies within our funds, even though around 60% of the fund value is included in the top 50 companies. So yeah, thank you to Rio for having me on this webinar, and I look forward to the discussion.
Sounds good. Thank you very much, Matthew. Before we start and kind of outline how the session will run, for participants currently in the call, you'll notice that there's a poll. Sort of an appetizer of the discussion, feel free to input your answers and we can just kind of comment off the back of that. And while panelists are answering this poll, maybe worth kind of outlining how we're planning this session. So we have a set of 8 questions that we've shared with Matthew, who's kindly prepared answers for these. It will be an open discussion guided by these questions. Really looking forward to your insights, Matthew, of course, within the remit of what you can answer. It will be very interesting to hear how Coller Capital is accounting for ESG integration within its funds and various strategies and different mechanisms and levers to prepare ahead of the transition. So we're starting to get a few answers in the poll, so thank you for participating. The question relating to how does a firm currently track and report on sustainability risk and portfolio management. Interestingly, the one that's springing to mind is one person answered, we don't formally track any sustainability risks. So hopefully our conversation can highlight how there is a strategic advantage of doing this. It sounds like the majority, 57% right now, are using internal spreadsheets and custom reports. Also third-party consultants, of course, who can provide guidance. Interestingly, no one is using a dedicated platform. So, hopefully we can tap into these questions and highlight the work that Rio and Coller are doing collaboratively on this topic. And indeed, what comes to mind, firstly, internal spreadsheets and custom reports, the business as usual, let's say. So hopefully our conversation today with Matt can help provide some flavor as to how technology can support ESG strategy and the transition. So yeah, jumping straight into it, Matt, thanks again for preparing. Our first question today will relate to how have you seen sustainability factors influence portfolio risk management strategies in the private equity space, particularly during periods of market volatility?
Thanks, Thomas. Yeah, so sustainability is used as one of many tools within our portfolio risk management strategy. It is another lens used to mitigate risk losses and increase alpha, i.e. used to reduce the amount of outliers from a poor performance perspective within our funds. And this is even more important in a period of volatility where there's likely to be more investments that underperform. Some specific examples of risks that we are looking at are reputational risk factors that could lead to lower revenues, i.e. loss of customers, indicators for increased costs, i.e. fines, energy costs, etc., and risks that could affect a company's license to operate, for example, health and safety or product safety. So in a period of market volatility, these are important aspects to consider when predicting investment performance in the coming years while you hold the asset. We also assess transition and physical risk, as well as reputational risk, in analyzing the exit environment for a company. So how easy would the asset be to sell at the end of the hold period? For us specifically, we also invest into funds that are managed by other investors. So in a period of volatility, there's always a tendency to invest in managers who have a higher quality risk management process, as they will likely be better at dealing with unforeseen issues. And quality sustainability processes is a very vital, important part of that. And so what we see in periods of market volatility is a shift from long-term benefits to short-term consequences.
Okay, that's very insightful, Matt. And I mean, we can agree that strong climate risk management and governance processes can overall improve the resilience of assets and the underlying investees as the market turns and shifts. I'm sure with the questions that we're going to discuss today, the common theme is ESG integration can augment overall resilience of the portfolio, considering a wider range of factors. So thank you for that answer. Leading on to the second question, we're really keen to discuss with you if you could share specific examples or lessons learned from recent markets or environmental disruptions where sustainability factors play a crucial role in managing risks.
Yeah, of course. I mean, I've only been at Coller for around 2 years, so until recently there has not been any severe market disruptions. And I guess I also don't want to speculate on recent events because we are unsure exactly how this will play out. But as much as sustainability is important at all times, in periods of high risk, it tends to be at the forefront of our minds because we want our investments to be resilient, right? So I'll start off and give a few examples of benefits we have seen at underlying portfolio companies in a period of market or environmental disruptions, and then some general sort of higher risk examples we have also seen recently. So from an underlying company point of view, we have seen success from an improved sustainability and governance process in a period of uncertainty for the sector, because this led to customers choosing this company rather than their competitors because they were more certain that they will be around for longer. We saw a company that benefited from focusing on employee job satisfaction in a market where employee retention was difficult. We saw benefits from a positive health and safety process leading to lower time lost due to incidents and costs saved. And we saw a waste reduction mentality, which we have seen multiple companies benefit from this in terms of finding positive ways to sell or recycle their production waste to reduce costs. An obvious one as well as energy efficiency, given recent prices, and all of these are great sort of indicators of a company's resilience in tough markets. From personal experience prior to Coller, I've also seen a mining company that was struggling financially, and they neglected the restoration of their mines. And in a period of wouldn't they potentially go under, they suddenly faced serious fines for not restoring their mine sites, which was a tipping point in terms of their going concern. So to move on to some more general examples at Coller, from my time here, we've seen a recent healthcare example where the company had a care facility for vulnerable people. There was a lot of recent negative media around harm caused to customers, which was a clear reputational risk and high risk of it leading to a drop in top line revenue and potential litigation. And so the ESG team was part of filtering out that deal. We had and it's a good comparison here, but we had a very similar healthcare example where there was some less proven or systematic negative media, And once we dived in deeper, we found that this was largely due to a media campaign that was unproven. This then led to our team being able to bid on the opportunity when other investment firms were hesitant. And this highlights for us how a detailed sustainability diligence process led us to having a competitive advantage. And it's due to the team's experience in the operations of companies that we were able to dive in on this level. Adam, the partner in the ESG team, comes from a operational partner background, and so that was incredibly useful.
That's really good insight, Matt. Thank you for outlining this. What I find really interesting is how effective due diligence can transfer into competitive advantage and also, wider resilience. Adding to what you're saying, there's a few resources that can kind of highlight the, financial services industry and how it can prepare to these risks and disruptions. There's one paper published by the European Security and Markets Authority in 2024 that looked at the impact of COVID-19 and how funds were, reacting. And there's three key highlights. Sustainability attributes positively influence fund flows during the crisis, suggesting that investors hedge on wider shocks by investing in ESG. ESG funds and those with high Morningstar ratings receive higher net flows overall. And an interesting point is not all ESG strategies perform equally. So funds using exclusions showed no significant difference compared to those that were more active and having a transition strategy. So, there's a few elements how integrating ESG, considering these wider factors, contributes to the bottom line of the companies in periods of high shock.
Exactly. And I mean, I think it's a great point on often when we think about risk management, it is about downside protection, right? But a proper risk management strategy also assists in terms of top line opportunity, in terms of having a greater process so that you can go for more opportunities.
Yeah, absolutely. It's interesting, ESG has been around for a while, but all these are research papers, so we don't have certainty. But I think one can argue certainly that accounting for wider factors, looking at topics that wouldn't be considered in regular risk management will definitely support resilience. So, I mean, thank you for sharing these insights. I like the mining company one specifically. It's quite, insightful.
It's a clear example of where it went wrong. Yeah.
Great. So moving on to our third question, we wanted to ask you, what role does integrating sustainability play in fostering resilience in private equity portfolios, especially against financial and environmental shocks?
Yeah, so I mean, we view it as an essential part of our fund hygiene. It's one of many tools. So sustainability is not the core reason why we do or don't invest in an opportunity. Obviously, given our team is 3 people large and the investment team is around 70, but it's an important tool used to highlight the higher risk opportunities that we see. So obviously, when you have market shocks, you are likely to see more high risk opportunities. And on the other side of the coin, as we've discussed, sustainability is a lens to spot opportunities to work with underlying companies to improve their own approach and drive positive risk-adjusted returns or an improved exit environment. On top of this, I think important to note that a market shock will often cause private equity firms to lower their valuations of opportunities, and this in turn leads to hesitance from firms to sell their assets and a lower deal flow in the private equity market. The lower deal flow poses a risk to firms who need to invest their funds, as they may be willing to accept lower quality opportunities. So an enhanced sustainability approach is an important part of filtering the opportunities you do want to do in your funds over the long term or don't want to do.
That's really interesting, and I guess it's a good segue into the following questions around how could private equity firms start navigating this? There's a lot of methodologies, but how do we fully integrate planning and measurements into action? And I guess it leads to the fourth question. What are the emerging sustainability risks that private equity firms should be aware of, and how can they proactively address these risks?
Yeah, sure. So, I mean, obviously, a key part of the last few years has been the climate environmental side. And what we see coming to the forefront more now is the S part of ESG. So, for example, human rights in the supply chain. And there's also likely to be a focus on nature and biodiversity in the coming years. Um, in terms of how can this be addressed, I mean, start to think about TNFD, TSFD work, and I would recommend using third-party specialists to analyze whether there are any risk present within your funds, and then from here you can choose whether to engage further and do more work based on how material the topic is for your funds, right? So for many private equity funds that invest in tech financials, for example, biodiversity might not be a core risk, but I think important to do the risk assessment portion of this, and then you can choose to do more work, and that'll ensure that you're sort of ahead of the game.
That sounds great. That sounds great. And maybe also adding to your points, looking beyond necessarily sustainability risk as a physical impact on the business. There's a very interesting Deloitte survey, from our previous place now, looking at private capital and ESG integration. And they highlight, as you rightly pointed out, how to effectively make it integrated into the business. They highlight three key challenges. I mean, considerable challenges in the disparate reporting frameworks and data sourcing require significant resource. Too oftentimes companies are bogged down into collecting, reporting, and compliance rather than advancing sustainability outcomes. Another one is aligning with key stakeholders, developing ESG policies. GPs and LPs are highly aligned, but they can always differ in how to capture value or in measuring risk sometimes. And then another one is demonstrating value creation. Some investors will regard ESG integration only as a risk mitigator, while others will view it as a value creator. So, the onus and the challenge is really, how to use well-recognized common languages, common methodologies to effectively translate risk assessment and value creators into opportunity. So, thank you for outlining it. And, we can lead into the fifth question, which is, in your view, what are the biggest challenges private equity firms face in embedding sustainability as a core part of their investment strategy, and how can they overcome these hurdles?
Yeah, so sure. I think this is a really good question. The reporting burden and sustainability is increasing massively, meaning it's becoming more difficult to show the value add element because the focus is on the data side, right? And as much as data is important, and I think it is very important coming from an accounting background myself, so sort of understand that dynamic, and it's required by investors. I think it's beneficial to use various tech platforms or third-party platforms to reduce this burden so that sustainability teams can also focus on the on-the-ground work. This is also positively impacts underlying investments because using tech platforms to get certain data points means that underlying exposures do not have to fill out numerous questionnaires. And on top of this, I also think sustainability tends to take a one-size-fits-all approach. I think it's important to be able to translate sustainability to everyone. But sustainability, when you think about it, nature and biodiversity, health and safety, energy management, it's often very nuanced for specific investors and underlying companies. And it's often difficult to understand the full picture from large and generalized data sets. So topic experts are needed, in my opinion, to understand risk and provide solutions to what is material to each company.
That's really interesting you say that, and that's also a point I'd like to highlight, and it's quite fitting because you're a qualified accountant, Matt. This is a personal analogy that I like to use, and I think currently sustainability, there's an analogy to make perhaps with the 1930s Great Depression. And the reason why I say this is about 100 years ago, There were no accounting standards that were commonly agreed. Different banks opposing each other on the street would use different methods to value their books. A British and a French bank would have, there was no standardization of accounting. And then ultimately, the advent of the 1929 crisis led to the creation of the SEC, who led to the GAAP and the IFRS standards, providing that common standardization and harmonization in the market. I think that all the ESG buzzwords, TCFD, SASB, CSRD, ISSB, SBTI, CDP, all these are attempts of creating that harmonization and standardization. But it's difficult. It will take time for the market to fully align on that common language. You rightly point out that sustainability can try to be all-encompassing. Sometimes it can get really specific. It's all a balancing game. And I guess for private equity firms and different players is how to select the appropriate mechanism to fully capture, communicate, and translate this impact and risk. When we look at the 1930s crisis, it took decades to fully implement IFRS. So maybe sustainability is at this maturing journey, but it's a interesting analogy that I like to use. The DWS greenwashing scandals may have some similarity with the Evergrande PwC scandal. As sustainability matures, and that's what these frameworks have been trying to do, and there's various challenges and political momentum to fully implement it. But it's something to bear in mind, I guess, for firms trying to navigate that space, how to use something that is proportionate, pragmatic, and that can, effectively drive the transition smoothly and resiliently for everyone.
Exactly. And I think it's such a great point about sort of where sustainability is on its journey, because you think about, tax is an example I love to use, because tax, when it first sort of came into the fore, it would have been a lot less rules. You look at tax acts now, and it's taken years and years of people trying to find loopholes or trying to avoid tax for it to sort of become the perfect system it is. And yeah, sustainability is still early on in comparison.
It's interesting to follow that space, especially with the latest political headwinds. Let's see where it evolves, but it's certainly finding the right balance is the key. I guess that's a good segue in the next question we have on the agenda. Based on your experience in the ESG team at Coller in your time, what are the key consequences of not accounting for sustainability factors in risk management? In your views, are these mostly operational, legal, reputational, market-driven, innovative, or workforce-related? Are there any other ones that are really springing to mind, big examples or cases that you've seen of big issues for investee companies not accounting for ESG?
Yeah, sure. So, I think honestly it ranges between all of these. Definitely for us, when we see such a mix of different opportunities, it is opportunity dependent on what are the key risks or consequences, right? But I would say from what we see on the investment side, it's mostly operational, legal, and reputational, and consequences could be low returns driven by higher risk, a smaller investor universe, fines, litigation. And then I would add that at the firm level, for us, workforce is also a key element there. Also, continually enhancing our sustainability risk management strategy has led to innovation within our process and broad benefits for the business as a whole. And in terms of other key topics that come to mind, I think it's sort of included within here, but I'd say the financial aspect of not doing sustainability, there's an opportunity cost there, which we've explained in terms of the competitive advantage you can gain in certain situations.
That's absolutely right. These are sort of well-known case studies, but as you say, the financial effect of not accounting for it. There's a few we could highlight: the 2015 Volkswagen emission scandal, ultimately costing the business $30 billion USD for fines, penalties.
Yeah.
the Wells Fargo accounting fraud related to governance, 3 billion of fines and fees, and the 2001 Enron scandal, highlighting social and ethical misconduct leading to the downfall of the company. So, I mean, clearly there is a business case of considering these factors and integrating them into the overall business strategy and management, because the ultimate cost, as you highlight, is something that is not negligible and worth considering from a financier perspective and underlying business. In your view, where are the biggest drivers to integrating sustainability risk management? Could you explain whether for you at Coller they stem from internal or external drivers mostly? What's your view on this?
Sure. So for us, it's definitely mostly the internal strategy, largely because of the value it brings, right, from the discussions we've had here. And however, there's also a benefit externally in terms of investor and regulatory demand. So that definitely plays a part. But what I would say is, if your focus is purely on the investor demand or regulatory demand, then there's a risk there that your sustainability process could become a bit of a box ticking exercise rather than trying to drive value.
Mm-hmm. I mean, fully agree. It's too often it can do the opposite. Drowning the audience in endless alphabet soups of data sets is not necessarily a proactive, pragmatic way of doing it. But I think one thing that from my previous role I've really seen as well is that tone from the top. It's having a company that has a very clear direction from its leadership on where it stands on ESG usually can drive towards really good outcomes. And I guess as a private equity firm, how do you identify, how do you probe these companies on these elements? Do you mind sharing more of that?
Yeah, sure. I mean, it's largely indicating to them the benefit. I mean, a lot do it themselves, right? And for us, a lot of our work is front end. So it is more about analyzing whether they have this in place. Are they open to developing this? In which case, with both of those, we are happy to invest, or do they disregard elements of risk for the company? In which case, there's a sort of red flag there. But what I would say is a lot of the companies we see are doing really, really great work on this topic. I mean, we recently went to see a underlying portfolio company in the US, and we were asking them about the political environment and whether this changes their thinking. And the response was really, we might change our wording slightly or, how we have to report on this, but really we are doing this because of the value it brings to the company. So it's something that everyone benefits from, and we're not going to change that from an operational standpoint.
No, I mean, that's really interesting. That's really interesting insights. As you say, active engagements, being removed from the underlying investments is clearly a challenge, and how to account for it is, how the industry will ultimately mature and drive this value. One thing that's interesting in the polls, respondents have really highlighted data availability and quality is one of the biggest risks faced, and that is ultimately more prevalent for the finance industry, being removed from the direct operation. Perhaps that is a good segue in one of the last questions we have on the agenda, Matt, and it's looking ahead, how do you see the role of sustainability evolving in private equity? What steps should firms take today to stay ahead of this transformation?
Yeah, sure. So I'll sort of tackle that data quality point because it's a really key risk for us, right, in our company. And the way we get around that is by using tech in-house experience to be predictive or to get estimations or to collect publicly available information so that we can report on this ourselves. Because for us, with our thousands of underlying companies, I mean, trying to collect that at that scale would I think take up too much time for everyone involved. And there just wouldn't be enough value there. And it's also about honing in on what's material, right? So rather than asking for lots of data points, what is relevant in this example, and then focusing on that. So that is that point, and then it ties quite nicely into where do I see sustainability evolving. I mean, I think in the coming years there will be a focus on the value adds, which I think is almost full circle to when you look at how sustainability started off, and it was largely operating partners and businesses going out to site and making improvements. So I see there almost being a full circle there, and I think it's incredibly important to make the reporting and data side as efficient as possible so that the core focus can be on driving value. So if I had to pick two topics to focus on to stay ahead of the transformation, it would be automation and technology in your process and value creation. And yeah, as I've explained here, they tend to work hand in hand.
No, thanks for that. And we're in full agreements. It's how to find the best way that is sensible without driving a whole business in just a compliance tick box exercise. I mean, at Rio, we have supported augmenting functionalities on tracking financed emissions. Finding ways to have quick dashboards to visualize the emissions hotspots across the portfolio. It's certainly a good way of, at least instead of aiming for the end goal straight away, do these implementation steps to then grow to a fully mature view of the portfolio is a sensible and efficient way of looking at it in the immediate. Because I think one of the biggest not controversies, but challenges in the industry is with the omnibus regulation with CSRD. I mean, in my previous role, I remember firms from Japan just contracting Deloitte, our team, to conduct CSRD double materiality assessments, preparedness, and exercises, thinking that they would be in scope later down the line. Ultimately, with the omnibus proposal changing all of this, represents a huge sunk cost to the business in preparation fees, planning ahead, and then you just get a sudden U-turn that is putting the business and its resources at risk. So as you outline, using technology to ultimately take that initial step, because private equity firms are not always mandated as much as highly regulated financial institutions. They're clearly not on the same level of scrutiny in the face of the regulator and the stakeholder. But then that cost of inaction clearly there's a pressure from the investors in the industry to drive it, and all the work that you are doing on Coller Capital side to use tech, facilitate, reduce the loads on the resourcing of your team is, in our view, at least a sensible and strategic approach to ESG. All these functionalities pertaining to tracking finance emissions, scenario modeling, high-level materiality assessments, establishing board governance, all these will help companies determine the picture of the portfolio and then drive strategic value and direction. So clearly we are in agreement here, and it's good to discuss this.
Yeah, exactly. And I think a good point that you made there, in terms of what you can then do with the data, right, afterwards. So I mean, for us, it's obviously we are quite a niche investor, and we will not have the time to go out to every underlying portfolio company. So this data is incredibly useful in terms of direction of travel, estimating, okay, where is the highest risk in your portfolio? And then from there, you can narrow down and go, okay, we're going to focus on here. This is where we can create the most value. So that link to collecting data where it's important, and then also going, okay, what can we do with this? What's the follow-up? Is a very important step.
And it's a positive loophole mechanism, I think, because the latest poll is overwhelmingly skewed towards regulatory requirements as the biggest driver for integrating sustainability in investment strategy. I think what's helpful is collecting all this data will not, go down a silo. There are, positive loop back mechanisms where regulatory requirements will feed into the overall strategy of the business. And ultimately, if we look at pieces such as the CSRD, they're mammoth undertakings that require just a tremendous amount of effort, but they do have the benefit of providing that direction and making firms think about topics that they wouldn't necessarily consider in the traditional risk management sense. So I think to the audience, I mean, clearly any step is beneficial in that way. Perhaps the best way is using that sensible approach to not go all in. I guess bet a few chips as you go along the way, because anyone will support the transition.
Exactly.
I mean, we've covered our questions. I think looking at the chat, we have a few queries from the audience, where we have about 15-20 minutes left, Matt. So I suggest we just go through these questions and we can comment as we go.
Sounds good.
So there's a first question from Eduardo asking about untrue ESG investments. I've seen some funds investing in arms, oil and gas, nuclear, etc. Is integrity relevant? Is there a recommended framework or regulation to avoid this risk? Maybe I can start, or how do you?
Yeah, happy for you to start. I mean, I have an answer if you want me to go as well.
I think my first comment is indeed this feeds back into the overall definition of what is sustainability. I think based on my previous experience, at least, there's the taxonomy framework, EU taxonomy framework that has provided, and there's been a lot of scrutiny and challenges around this element. When the taxonomy first came in, nuclear and natural gas were not included in the framework. But ultimately, the commissioners agrees that there was a benefit of defining what transition finance could look like in the terms of ESG. So ultimately, the regulators have released specific criteria for nuclear, natural gas. Now, whether people agree it's not sustainable is a different topic that pertains to the ideology, I'd say. But it's how do we define transitioning brown assets to greener assets over time, I guess is the question. There are frameworks. I've mentioned the EU taxonomy. I know that net zero target setting frameworks will provide some guidance on these elements, but it's ultimately how to communicate it in a way where it doesn't appear like greenwashing, essentially. How do we define a method to show the progress over time of transitioning these assets? And when you look at the EU taxonomy guidance for oil and gas and nuclear, natural gas, there are very clearly defined thresholds establishing by this given date, the energy intensity of the carbon emissions needs to reduce by this amount. By this date, it needs to reduce. Cars are another example. They can pollute in the time being, but by 2030, they need to be zero emissions. So it's how to define that transition piece. And it comes back to our points about some ESG funds have not performed as well when they have exclusion strategies. If you just exclude the whole segments of the economy, then the net zero transition won't effectively go ahead. At least it's my view, and I'll hand over to you, Matthew, if you want to add anything.
Yes, thank you. So, I mean, I think in my opinion, you have to differentiate right between sort of impact and I would say sort of more general investing. In the impact lens, obviously, you are targeting right positively impacting companies. So there's an element of that because you care about more than just financial returns. There's an element of you are willing to sacrifice more returns. So I think that maybe is a separate topic. I mean, I know for us, in terms of what we are willing to go into, it is not about sector exclusions, exactly like Thomas has been mentioning. I mean, often right with oil and gas companies, for example, that is where you can have the most impact yourselves in terms of future-proofing the company, right? And it is more for us about, we invest now, we're going to have to sell this asset in 5 years' time. Is it going to be a more difficult selling environment in 5 years' time? And so if we have to invest in a company that we think is going to do well in the next 5 years, we will work with them to make sure that that exit environment is improved. So I think many layers to that. I mean, for us ourselves, we are not exclusive. We always prefer to invest and improve. But yeah, thank you.
Thanks, Matt. Good question from Anna. How does Rio help Coller simplify their data sets? Looking into how we can make our reporting processes more streamlined, and it would be good to hear about your working relationship. So I'm happy to take that question. Coller, Rio supports Coller mostly on financed emissions, aligns with the PCAP methodologies, the Partnership for Carbon Accounting and Financials. Ultimately, taking data sets from funds, we saw a few polls saying tracking ESG using Excels and data sets. Rio provides a streamlined platform to upload these data sets across the fund, and we use a variety of parameters to essentially estimate emissions at a high level in a quick snapshot view. So as Matt outlined at the beginning of the session, with 1,000 underlying investee companies, sourcing the data, the carbon emissions for each underlying assets is not only a crazy undertaking, but also just immense exercise. So to facilitate the ultimate view of finance emissions in the fund, Coller Rio provides some estimations based on different parameters from Coller's data set. And we're ultimately able to produce a financed emissions estimation metric across the different funds, helping Coller visualize what is the most carbon intensive investments sitting in each fund, and allows comparison and reporting to investors and stakeholders. One work stream that we've been working together is sort of working on the PCAP data quality scale. So one benefit is estimations are useful for the time being because they can provide that snapshot view, but then ultimately, how do we move towards more accurate data, finding the actual assured emissions of the underlying investee companies is an avenue that we've been exploring and are working together on. But hopefully that covers our partnership. Matt, if you want to add anything to what I've said, please do.
Yeah, no, I think that covers it really well. I mean, obviously, mammoth task that with, because we've covered all of our funds. So you were talking about closer to probably 10,000 underlying companies. And I think that point on moving to improved data quality is a really important one in terms of the next steps. I mean, we've taken great strides for a secondaries firm in terms of what we can do currently, and going that next step to collecting reported emissions would be a great sort of transition. And I think an important part of that is transparency in terms of if our underlying companies are reporting their emissions, then for us it's with the various platforms that are now available, there's an ability now to go and collect those figures.
Great, thanks, Matt. Moving on to Rupi's question, similar to Eduardo's, questions on thoughts on the application of the minimis approach to exclusion policies. Example, giving exposure might be non-material to the total fund's assets, and for LP-led secondaries, access to information is sometimes limited to fully assess risk. Perhaps that's a question for you, Matt. How do you find, this? How do you access information that is not always available? We have certainly gone through the line items of the fund, and sometimes there's no company information. The assets are in different geographies that don't have the same regulatory regime. So getting this data can sometimes be a challenge. Sometimes it works well, but sometimes it's difficult. Keen to hear your thoughts, Matt.
Yeah, definitely. So I mean, for us, we, as you've seen, I mean, we've made great steps in terms of our data quality. So we now, for our equity funds, have full visibility of the underlying exposure. However, that comes in various sort of levels of detail, right? So we'll have a company name, industry, location, and then we can dive in further from there. But it is difficult, right? Because obviously, when you are including de minimis thresholds in terms of investor exclusions, running through potential opportunities, which could have hundreds to thousands of exposures, is a difficult task. It is something we do. I mean, we are always willing to accommodate for our investors. We in terms of our own policy, we try to limit as much as we can to our direct secondary transactions, which are about 65% of our equity funds. And then the remaining LP-led, as discussed, there are certain investors we can go further, and we are working on trying to automate that process as much as possible, because historically it's been a very manual search through each company.
Indeed. I mean, it's a challenge and a common industry theme. The access to reliable data that can feed into the insights and can be collated easily. We certainly do hope, looking at the markets, how standardization, regulatory frameworks that are being mandated on underlying investee companies will help spread commonly data that is easily benchmarkable and accessible and sourced. The only problem is only time will tell if there is an effective adoption of the market on these data sets. One of the a difficult issue for financial institutions to navigate. So at least Matt's answer and the conversation now at least provides a flavor of what firms can do right now, and then ultimately as the market matures, find new ways of effectively having more access to underlying data. Another question from Jason, asking, how do you balance the trade-off between short-term financial returns and long-term sustainability goals when constructing a resilient investment portfolio? How do you find it difficult to find investors? And do you find it difficult to find investors, or is there significant appetite for general ESG investments? At least immediate remarks that I can say regarding the appetite for investors and interest from the industry. Clearly overall, when we discuss with our clients, EU-based investors, at least institutional ones, are pushing. We get a lot of clients who work in the construction industry who get questionnaires from investors, and you can get a very simple one, or you can get an extremely lengthy, very detailed questionnaire. So there is some drive and appetite to, at least from an EU-based focus, to drive. On the other side of the Atlantic, I'm sure we're all aware, there's been perhaps a change in the discourse on the interest of investors and appetite. I think that's perhaps just my personal belief. Even though the wider economy might not be aligning to the discourse, I suspect that the US North American market will be more concentrated in specific companies really driving ESG, kind of diverging away from the general discourse. I remember seeing reports from KKR and American private equity firms being extremely ahead on ESG disclosure and the process of financed emissions and driving it. So ultimately, I think there's also a big driver globally as the ISSB adoption, whether that will make companies and countries embark on the common sets of factors and drivers for ESG integration. Only time will tell. But it's maybe Matt, you can speak more of your side at Coller Capital. How do you find it? Is it difficult? Do you get a lot of interest from investors on these topics?
Yeah, we do. We get questions around sort of impact investing, but what I would say is that for us, we use sustainability or ESG as a way to protect investor value, right, and drive value within our funds. So we do not target positively impacting ESG investments, although those could be used as indicators for where there could be financial value. The other point around the short-term value versus long-term value is, our job in our team is not necessarily to decide on what we are going to invest in, right? So it is about getting as much information as possible so that our investment committee can make the right decision on what to invest in. What I would say is that often the long-term value is disregarded because it is not within the next 5-year hold period. However, you need to sell this asset at the end of that 5 years, right? And so whoever is buying that asset will be considering the 5 years beyond that. So the long term comes into play when you're talking about the exit environment.
No, that's very interesting insights. Indeed, the whole period, we have another clients, it's their bread and butter, let's say. How do they include effective collection of ESG data at the OM and IC stage, and then ultimately find ways of improving the value of the assets, which is really exciting because it demonstrates how financial returns in themselves are not just purely, it's one element of the puzzle, and ESG can support it. I did pick up a few examples. There was a report in 2024 from the PRI looking at how ESG factors affect returns. What's interesting is they've collated a set of research, and McKinsey finds that management teams that chase growth without considering how strategies can impact planet, people, and long-term sustainability increase their reputational risk and are less likely to have full growth potential. Rockefeller Asset Management highlighted that improved corporate performance due to ESG factors becomes more marked over a longer time horizon, and ESG integration performs better than negative screening, which kind of echoes our conversation we had today. Ultimately, the integration of ESG in asset selection and portfolio construction can provide protection and lower volatility. So as you outlined, Matt, it's not a siloed exercise. Let's say there is a business case for improving long-term value creation and mitigate risk.
Exactly, and the one point I'd add to that is, I think sometimes there is a belief that ESG or sustainability is all about long-term value. For us, it's sort of all-encompassing, right? I mean, if you look at the governance section of that, you're thinking about fraud and everything. There's a lot of, or litigation, right? There's a lot of risk to take into account in the short term. If you think about health and safety of employees and how that could affect, the operations of the company. So there's a lot to consider in terms of short-term and long-term. I think there's aspects that are more long-term. For example, if you're looking at your climate KPIs, that is obviously more long-term, but there's a lot to take into account in the short term as well.
For sure. And I think it's one of the big headlines that we like to say at Rio is you can't manage what you can't measure. So ultimately collecting all this ESG data will support the overall strategic direction and value creation and financial stability and prepare for volatility. So there is certainly a lot of value in considering it and driving it for the business. Unless there's any more questions from the panelists, thank you very much for providing these in the chat. Perhaps we can give a couple minutes to let people add in any more questions that they may have. But we have 7 minutes left. So maybe can ask you before we conclude, Matt, any closing remarks on the discussion today that you'd like to highlight? I certainly found that it was a very interesting and insightful discussion.
Yeah, thank you. I really appreciate that discussion. It was very insightful. And I think the one point that you mentioned through this, which I think is a great one, is a lot of these issues that we think about when it comes to sustainability, there's an element of the unknown, right? Because there's so much nuance there, and it covers so many topics. That really taking that first step is such an important part. Just engaging, finding some specialists or a platform that can easily measure something for you is a great first step.
And I think I remember seeing a industry, sort of a panel discussion, and you were there, Matt, with Adam.
Yeah.
And I remember him saying something that really provided a very insightful view of seeing things, and it's ESG can be a ESG-led exercise led by an ESG team, but ultimately the real value is connecting all the different stakeholders that have their different technical knowledge and skill on specific topics. And that is the value, is bringing all these stakeholders together that can bring different elements of the table. If ESG is siloed and it sits on the office somewhere in the top floor, isolated, then it can't effectively drive. The real value is bringing all the stakeholders with their different sets of expertise to drive the narrative and the strategy forward. Is a point that Adam made that really echoed, I thought it was very pertinent to this overall discussion.
Exactly. Yeah, it's a good point. I mean, for us, a big benefit is the fact that we sit within the investment team, and it is also the fact that there's two of us right in the team. So we are the two ESG or sustainability specialists, but our ESG committee is made up of 10 people high up from across the firm, right? So it is very much a group effort, and the mindset is very much on problem solving rather than problem creating.
That's well said. That's well said. Thanks, Matt. It's great. I think we've got 5 minutes left. I think we've covered things, so we can give back a bit of time. Thank you for your messages on the closing remarks in the chat. It's really appreciated. Just wanted to again say thank you to everyone for joining. I certainly had a great time to discuss today with Matt, and wish you all a very good day and continuation. Let you close, Matt.
Thank you. Yeah, thank you, Thomas. Great discussion, and thank you everyone for joining and for the great questions there.
Sounds great. Thank you.